In this presentation, we're going to create an invoice where we will be selling inventory. In other words, we're going to make a sale of inventory, in our case, a guitar, and we have not yet received payment on it. We expect to receive a payment in the future. Therefore, we're going to create an invoice rather than a sales receipt. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. Let's take a quick look at the desktop version so we can see our flowchart. So here's our flowchart. We're in the customers section here. So we're going to be over here. We're going to be creating an invoice. So look at the flowchart that's going to be happening here. We're selling guitars. We're imagining that a guitar was sold. So typically when a guitar is sold, it might be done in the shop. You can imagine it being done in the shop, at which time we would get payment at the same time that we give the guitar, where we would be making a sales receipt. However, we're going to be making an invoice in this case, and that would be the more unusual case for inventory, but a typical case in other types of companies where we would do service oftentimes or work before we send the invoice. So in this case, we're going to say that we have the guitar and we invoice the guitar, possibly shipping the guitar with the invoice on it before we got the payment. Then once they receive it, they're going to basically pay us in the future. Therefore, this is going to be dealing with accounts receivable as opposed to us getting the cash at the same point in time, which would be done with the sales receipt. So we're going to ship the guitar. We're going to have the invoice with it, basically the bill. We call it an invoice on our side. That's the terminology. Then we expect to receive a payment in the mail, and then we're going to deposit that payment into the bank. All right, so we're going to be at the first step of our process. That's going to be to create the invoice. We're going to do that by selecting the plus button up top. We're going to be going into the money in. We're looking for the invoice. Now, notice this term's a little bit deceiving. They tried to kind of shorten up their terms up top. Obviously, we don't have the money yet. This isn't money in, but it's in the cycle of us getting money. We're going to send the invoice. Then, of course, we hope to get the money in after that point in time, in which case we'll record the sales receipt. And that's when we actually have the money. So we're going to start here. We're going to say, here's the invoice. We're going to say this is the customer Jones Guitar. Jones Guitar wants to purchase a guitar. We're going to say, all right, we're going to ship that out to you. We're going to say, Jones, you're a good customer. Therefore, we're going to ship it out to you. And you just pay us once you get our invoice and the guitar here. So we could just populate Jones Guitar here because Jones is already in the system. So we're going to populate Jones Guitar and say tab. If we have the email address, we can set up the email address. We can also set up other online payment options. Then we're going to go down to the billing, or let's just tab through this. We've got the billing information, then we have the shipping information, then we have the terms. The terms basically mean how soon we expect to receive payment on this invoice. So they're 30 days, net 30 at this point. So then we're going to have the date. If we say the date is going to be 1/12, so I'm going to say the date is going to be 1/12/2020. Therefore, the due date, 30 days, net 30, is 2/11. So it's going to be done on 2/11. This populated automatically for us. Then I'm going to scroll down. We're going to pick up the inventory item that we want. So the inventory item, we could select the drop down, or we can simply start to type it in. We want the Gibson USA. So I see it right there. It's the Gibson USA. That's the one we want. So that's the guitar we're going to sell. Description populates for us. Look how easy the data input is on the invoice. We're going to sell one of them. The rate is going to be for the 380. We know that rate because it's in that populated for us, in other words, because it's in the items when we set up the item, the Gibson USA. So the 380 is going to be the total, and it is going to be a taxable item. So we do have the taxable item for it. If we then take a look at the total down here, we have the 380. And then the 3610 is going to be the sales tax calculated here. Again, this is based on basically a California sales tax. So it'll be based on the location that you put into the system. If you wanted to match this one, you got the California tax. If you want to adjust it for whatever reason to kind of match out the system that we're working here to match out the problem, you can manually input the sales tax calculation by overriding it down below to get to this same number, the 3610, to match the problem. That's going to give us the total of the 416.10. So 416.10 total. So see how easy it is to populate the invoice. Now let's think about what the invoice is actually doing. Now it was easy to populate because of course we already had these items set up. It's now going to be affecting the financial statement, and it's actually a fairly complex form to know how it's affecting the financial statement. Let's think about it. Well, it's an invoice, therefore it's going to be increasing accounts receivable. So whenever you hear invoice, AR, accounts receivable, goes up, which represents the customer owing us money, the customer being Jones Guitars in this case. It's going to go up by the total amount, including the sales tax of the $416.10. And then the other side is going to be on the income statement, sales, income, revenue. That's going to go up not by the $416, however, but only by the amount we get to keep, which is the $380. The difference between the two is going to increase a liability account, basically sales tax payable, although QuickBooks will put it to the agency we have to pay, of the $36.10. So that's going to be the first half. I would think about that as one kind of journal entry. Then the second journal entry that'll basically happen is inventory needs to go down because we sold the Gibson guitar. So it's going to go down, but not by the $380, but by the cost, which isn't on the invoice at all because it's driven by the item that we had set up and the inventory flow assumption, which is average, weighted average method, is typically going to be used by QuickBooks Online. So it'll decrease the cost of goods sold. It'll decrease inventory, and the other side will go to cost of goods sold. So let's record this and then go to the financial statements and take a look at all that. Now, I would recommend doing that with every form. Not every form is as complicated as an invoice because it has the sales tax and the inventory. But you want to basically understand the form and then check the financial statements to see if you understand how they relate to them. So I'm going to go ahead and say save and close then. Let's save and close that. Then we're going to take a look at our financial statements. I'm going to go down to the reports down below. We're going to open up our favorite financial statements. We're going to be opening up the balance sheet. We'll open up the balance sheet. That's our favorite one. I think I like that one more than even the profit and loss. So that's the balance sheet. I'm going to go up top and I'm going to change the dates from 01/01/20 to 12/31/20. We're going to go ahead and run that report. Then I'm going to duplicate that report as has been our practice in the past. Going to right click on the top tab. Going to duplicate that tab. We're going to do the same for the income statement now, or the profit and loss, or the P&L. We're going to go down to the reports on the tab to the left. We're going to be opening up our second favorite report. It's my second favorite. You might like it like as much as the balance sheet, but I'm going second favorite with the profit and loss, the P&L. Going to go back up top. These are the major financial statement reports, of course. We're going to say this is 01/01/20 to 12/31/20. And then we're going to run that report. Then I'm going to go to the tab up top, going to right click on it, and we'll duplicate that tab. Now I'm also going to open up the third report that I think you should really get used to. I get used to it because it's a short, easy report to look at, even though QuickBooks puts it way on the bottom of the report list, which is, I don't think it's fair because I think it should be one of our favorite reports, and that's going to be the trial balance. So I'm going to open up the trial balance, and we'll have that one up top as well. Changing the dates once again from 01/01/20 to 12/31/20. Then we'll run that report. Then once again, I'm going to right click on the tab up top, going to duplicate that report. Now, I'm going to make this a little bit larger on the trial balance. So I'm going to close the hamburger, going to left click, I'm going to hold down control and scroll up a bit so that we're at like a view of, let's say, 125. Now, first, if we look at the trial balance, notice how it's all in kind of one place here. So I'm going to look at that first and see if we can kind of get used to it. I'm going to wean us over to the trial balance possibly and more. So we got the trial balance. So the invoice that's going to be happening here, when we made the invoice, we know that the accounts receivable is going to go up. So let's go into the accounts receivable and say what happens to accounts receivable. And we see then that we have our invoice down below. And it's in the format of the form type is an invoice for 416. So I'm going to open that up. And if we open that up, we're going to get back to our invoice that we actually created. And of course, that 416 is the total amount, which includes the sales tax. So it includes the sales tax. I got to hit control and scroll down a little bit so they let me see it. So here's the full amount. Then I'm going to go back and close this back out. And we're going to go back to our report up top, back to the report summary. Then the other side of that goes to sales, which is nice. It's down here. We don't have to jump to another report like the income statement to do it. We just go right down here. There it is. There's the sales of the product, 380. Let's take a look at that. Notice it's only 380 with the same invoice. So it's the 380, which the whole amount was that 400 and something, 416. So this is only the amount we sold for, doesn't include the sales tax. What about the sales tax? Where does that go? So if we close this back out, we say, all right, where's the sales tax? It's going to go to some kind of liability account because we don't get to keep it. It's not really income to us. It's actually going to the government. So that's going to the state. They're just using us to collect money that they have to take from. So it's going to go here, which is basically a liability account. And for us, it's going to be going to the California Department of Tax. They could have called it sales tax payable, but they put it in there by department. They basically put the vendor as the account here, which is kind of funny, but that's what they have. So then we're going to go into the 3610, and there is that. And notice it's breaking it out. It's the same invoice, but it's breaking it out into the components of the sales tax components. So it's breaking it out into these 3 components. I'm going to then go into any one of those, and that'll be the sales tax. So there's the sales tax of the 3610. Okay, so you would think we'd be done there, but we're not. We're not done there because there's also the inventory that went down. So the inventory went down, and that's going to be here on the inventory. So let's check that out. Let's go into inventory. It should have decreased. So then here's the invoice. It's decreasing the inventory by the 304. 304. I don't even see that number on the invoice at all. This is the invoice that says it's the 304. There's no 304 on this invoice. Why? Because we don't want to tell the cost on the invoice, but we want the invoice to drive the recording of the cost. So how does the invoice know what the 304 is if it's not on the invoice? Well, we could find it. We can go back to the reports over here, and where it's generating that information is when we went down to, let's go down to the sales information. And if we go into the products and services, then we entered this information, or it's tracking it from the cost that we put in for these items. So the item we sold was a Gibson USA. So if we look at the Gibson USA, we have the cost of the 304 here. So, and it's going to use a weighted average method for the cost, but they all cost 304 for us, so it costs us 304. So that's where the 304 is coming from there. And so then I'm going to say, all right, that makes sense. So I'm going to close that out. There's got to be another side to that, one more account that's going to be affected. So I'm going to scroll back up and say that's going to be the cost of goods sold. Cost of goods sold. There's the cost of goods sold also at the 304. All right. That's the cost of the inventory we consumed. Okay, so now I'm going to go back up top and say that makes sense on the trial balance. What would it look like on our financial statements? Like if I did the same kind of bouncing around on the financial statement, I could say, let's go to the balance sheet first. On the balance sheet, we know that accounts receivable went up. So there's accounts receivable right here. That's where it shows up on the balance sheet. Notice all the subtitle totals you have here. You'll recall that went up for the full amount, the 416, the full amount of the invoice. The other side of that is in the profit and loss. I would then have to jump to the profit and loss, which sales went up. The first line sales went up, but it only went up by the 380. So there's the 380 in the sales for that invoice. And then if I go back to the balance sheet, well, what's the difference between the two? It went into the sales tax payable. Back to the balance sheet, and back to our reports. It went into a liability account, and that's going to be down here in the liabilities, which went to the sales tax payable, which they called the department, basically the vendor we have to pay, which is the California Department, and so on and what's up. So there's the 36. Then we also have the inventory going down. It's up here in the assets section where we have the inventory asset here. It went down, you'll recall, by that amount that's not on the actual invoice, but that 304. And then if I scroll back up, the other side of that 304, I'd have to jump over to the profit and loss report. It's on the P&L report. And that's going to be the 304 here, cost of goods sold. Bottom line on the income statement, we made a sale for 380. Revenue went up by 380, but we had to give up something, consume something, a guitar that cost 304. Therefore, the net increase was $76 to our net income on the income statement. Okay, if we go back to the balance sheet then, also note that this accounts receivable went up, and that means that people owe us money. And that the question is then, well, who owes us money? And we can then run another report, the detailed AR, to say who owes us the money. Because if I look at the detail here and the transaction detail, it doesn't show us who owes us the total money here, because it only shows us by date. So then to support that number, we can then go to the first tab again. And we're going to go then to the reports. So we're going to go down to the reports. We're going to be looking for the accounts receivable detail type of report. So I'm going to scroll down. We're looking for who owes you. We want the accounts receivable, our customer detail. customer balance detail. Customer balance detail. That's the one we want. So I'm going to select that one. Then I'm going to go back up top and we're going to change the dates. I'm going to make a custom date. I'm going to make it as of 12/31/20 and run that report. And so then you'll see that we have the Jones down here. There's our invoice for the 416, adding to the balance that Jones owes us. The total here then being at the 20,916, which if I go back to the balance sheet, supports that 20,916 here. We have a similar kind of situation with the inventory assets. We have the inventory being here on the balance sheet. We have the transaction detail, which I can go to by just clicking on this number, but that only gives it to me by date. So we can run an inventory type report by going back to the first tab, going back down to the reports down below. And if I want to then say, I usually search for this one, I want to find the inventory valuation summary. Inventory valuation summary report as of, I'll just make it 12/31/20. Run that report. And so there we have it. And I think the Gibson USA is one of the items that we sold, but the bottom line, this is what we currently have on the books right now in terms of our inventory by unit and type of guitar. We're at 2,592. If I go back to the balance sheet, that should match out the 2,592. So we have the supporting information related to the inventory.